Welcome to the Daily Block, the top events from the past day in crypto, and why you should care before FOMO or paper hands ruin your week. Bloomberg says SEC move makes ETF approvals effectively 100%. The SEC told issuers to pull 19 B4 listings because it has generic listing standards now. So Bloomberg analysts reckon the only formal step left is S1 registration. That clears the runway for a tidal wave of spot ETFs, Bitcoin, Ether, and a bunch of altcoin-linked filings like XRP, ADA, and Doge to flip from paperwork to tradable instruments once Corp Finance signs off. Expect filings that sat in limbo to sprint toward market debut if the S1 path goes smooth. Why it matters for crypto investing. Spot ETF greenlights can drop multi-billion-dollar liquidity into the market and violently re-rate any asset with an ETF filing. Risk or counterpoint. The SEC can still slow-roll sign-offs, attach conditions, or trigger litigation, so don't lean in full size until filings actually clear registration. Okay, next up. U.S. government shutdown risk spikes, and volatility is on deck. Political deadlock has odds of a federal shutdown jumping to about 80% ahead of October 1st, which means economic data releases and regulatory timelines could grind to a halt. A shutdown would scramble the usual calendar, slow down policy work on things like the Clarity Act and SEC processes, and pump up dollar and treasury volatility. Traders should expect whipsaws and delayed approvals across the board. Why it matters for crypto investing. Shutdowns create short-term macro uncertainty and disorderly moves in risk assets. Tighten sizing and expect gaps. Risk or counterpoint. Shutdowns are typically short and markets price them in quickly. The calendar risk can still blow up precise timing on ETF launches or legislative fixes. Moving on to banks and plumbing. Swift teams up with Concise to add a permission-to-blockchain ledger to global rails. This is not a public blockchain for degens. It's bank-grade plumbing meant to connect tokenized deposits, CBDCs, and digital asset platforms to the existing Swift network. If big banks start routing tokenized liabilities through Swift's rails, it could sidestep stablecoin corridors that currently handle cross-border settlement or alternatively bring banks into tokenized settlement at scale. Expect a slow institutional reshuffle of how money flows between on-chain and off-chain systems. Why it matters for crypto investing. Cheaper, bank-native tokenized settlement could reduce the arbitrage edge stablecoin corridors, exploit, and shift on-chain liquidity paths. Risk counterpoint. Permission setups can entrench incumbents and introduce counterparty constraints that limit the open liquidity DeFi traders love. Next, FTX pushes $1.6 billion back to creditors, and that fresh cash could fuel markets. The trustees' distributions will return more than 100% to principal for small claimants and materially boost recoveries for larger creditors, releasing $1.6 billion in known liquidity now. Those pockets of cash often redeploy, and historically they can flow right back into altcoins and exchange order books. Perfectly timed for the seasonal Uptober narrative and ETF fever. Keep an eye on OTC desks and exchange inflows for sudden buying pressure. Why it matters for crypto investing. Cash hitting former creditor accounts can be immediate fuel for rallies and alt squeezes if redeployed into markets. Risk or counterpoint. Redistribution doesn't guarantee buys into risky tokens. Some recipients will deleverage, hedge, or cash out, producing mixed effects. Switching gears to law enforcement. UK convicts a Chinese fraudster and seizes £6.7 billion and 61,000 Bitcoin. After a 7-year probe, UK authorities are holding one of the largest crypto hauls in history, now under custody as courts decide sentencing and potential liquidation options. If that stash gets auctioned or sold, it could add significant sell pressure to Bitcoin markets, but if it stays locked under state custody, it acts like temporary supply removal. Watch for on-chain movements and any formal auction notices. Why it matters for crypto investing. Large seized Bitcoin hitting markets can create meaningful selling pressure. Custody by authorities can also remove supply temporarily. Risk counterpoint. Governments often stagger sales to minimize market impact, but unexpected dumps or leaked plans can still trigger sharp moves. Regulators are sniffing around tokenized treasuries. The SEC and FINRA probe over 200 digital asset treasuries for insider trading. Regulators have contacted more than 200 T products about suspicious pre-announcement trading patterns, signaling that tokenized treasury offerings are being treated like securities with insider trading rules. This could be the start of a broader enforcement sweep that forces platforms to upgrade compliance, disclosure, and surveillance. Expect headline risk and rapid repricing of any product tied to on-chain treasury yields. Why it matters for crypto investing. Enforcement raises immediate headline risk and will force repricing, higher compliance premia, and de-risking flows for tokenized treasuries. Risk counterpoint. Some products may survive with stricter controls and carve-outs, but legal uncertainty typically reduces tradability until clarity arrives. DeFi headline: Aster, a new decentralized perpetuals DX, explodes with 2,000 to 2,800% moves and fat fee revenue. The protocol minted massive volume right after launch. Aster token price ripped multiple thousand% as fees surged, and a tiny number of whales now control a huge share of supply. It's outcompeting rivals on fee income for the moment, attracting retail and institutional flows alike. But whale concentration and leverage mean liquidation cascades could be nasty. This is pure high beta DeFi mania with real macro tail risk. Why it matters for crypto investing: high volatility DeFi launches create tradable squeezes and margin cascades that can make or break levered accounts. Risk counterpoint: extreme token concentration makes the move fragile. A coordinated whale exit or exploit could annihilate holders. Contagion could hit other venues. Last but not least, Shibarium Bridge hacked for 2.4 million, and Shibi got dumped. The Shibarium Bridge suffered a flash loan style exploit, prompting validators to pause operations and devs to plan a leash v2 migration and other fixes. Shiba price plunged, on-chain volume spiked, then cratered, and user confidence in that L2 ecosystem took a hit. Meme coins tied to fragile bridge tech keep showing bridges are the weakest link. Why it matters for crypto investing: bridge exploits instantly force dumps in meme coins and any asset reliant on L2 plumbing. Avoid leverage and monitor validator health. Risk to counterpoint: quick fixes and migrations can restore confidence, but bridges tend to have repeat attack vectors until fully reworked. Quick tactical takeaways for traders: treat ETF approvals as the dominant medium-term liquidity story, while respecting regulatory and congressional timing that can upset calendars. Watch SWIFT and bank tokenization for longer-term rotation away from stablecoin settlement corridors. Monitor on-chain whale addresses. Seize Bitcoin movement, FTX payout distributions, and bridge contracts. Headlines move markets fast, and chain data tells the story. Finally, DeFi and meme coin launches are tradable and violent, but carry asymmetric tail risk from hacks, whale dumps, and liquidations. So reduce leverage, scale entries, and have explicit liquidation thresholds. Subscribe for a daily jolt of market yellow journalism with receipts and chain links, and hit the bell if you enjoy watching chaos get analyzed like a lab rat. That's today in crypto, where the gains are imaginary and the pain is real.